Hello everyone, welcome to today's session in Concept. In today's video, we will be learning about gap strategy. Many traders, they love to trade the gap, but they are not able to do so. It is a strategy that can give you an instant profit in a very short time, but if you will trade it in a wrong way, it can give you a major loss as well. So today, we will be talking about that strategy. We will be covering all of the gaps, their properties, and how you can trade them. Okay, but before starting the video, if you are new here, you can go in the description. There is a link below. With the help of that, you can download and install Concept web application. After successful registration, you will get some free tools that will help you out in your trading. We have a separate video library in the application as well. So in the video library, you will get multiple videos based on Pro Plus tools as well as on various strategies. Okay, and these videos are available in multiple languages, so you can watch them in your main time. Now at any point of time, if you guys are having any kinds of doubts or query, so you can contact us. You just have to go in the support and you will get our contact number as well as email ID, so you can contact us and we will be there to sort your queries out. Let's start today's video. In today's video, as we will be talking about gaps, so the first thing is that what is a gap, right? So the gap is usually the difference between the closing and the opening of the market, right? Okay, very simple. Now, when we talk about different kinds of gaps, okay, so that is a challenge for us, because first thing is that we will talk about the gap up first. Okay, what is a gap up? Right now, there is a misconception among traders about gap up. Okay, so I'll clear it today. Now, for example, your market, this is a day candle. Okay, so first this was a candle somehow like this, and then the very next candle is like this. Okay, now after that, then there is a next candle that is somehow like this. Okay, now you can see this candle was closed here. Okay, so I can say approximately at 380. Let's suppose it closed at 380. Okay, the very next candle, it started from here. Okay, so it started from, you can say at 370. It started from 370. Okay, now I'm expecting a gap up opening in the market, right? I'm expecting the next day the market will be gap up opening. Okay, so my market started here. Okay, so this was the candle. Okay, and my market, it opened approximately, you can say at 390. Right? So is it a gap up or not? Okay, so it is a gap up or not? So the answer is no. This is not a gap up. Now why? Why? You can see there is a difference. The previous day closing was 370. My market opened at 390, but still I'm saying this is not a gap up. Why? Because I will only consider a market to be gap up when the next day candle, it will initiate above the high of the previous candle. So that will be my gap up. Right? So let's suppose if the high of this candle, is you can say 410. Okay, and if on the very next day, if a market will open above 410, if it will be opening at 420, only then I will consider it as a gap up. Okay, and whenever there is a gap up, okay, so only then my market retrace back to fill that gap, and that is what you know as gap filling. Okay, so the gap filling works flawlessly whenever there is a proper gap up in the market. Okay, when the next day candle is you can say is starting above the market, the previous day high. Okay, similarly, if there will be a gap down opening, so the next day candle, it should be opening below the low. So for example, if the low is 365, okay, so I want the next day market to be starting below, you can say approximately at 350. Okay, so it is starting below the low of the previous day candle, and that is what is a proper gap down in the market, right? So many traders are confused here. So if you will see this type of gap up or gap down, okay, so this is considered as a common gap. This is considered as a common gap. Okay, now what is a common gap? That is a second kind of gap. Okay, so we talked about the first one, that is a gap up, or you can say gap down as well. So we have covered both of them. Okay, so what was that? What was that? When the next day candle will be opening above the high of the previous candle, that will be gap up. Okay, when the next day candle will be opening below the low of the previous day candle, that will be gap down. And whenever you will analyze this type of condition, okay, so then it will always, you can always go with the gap filling. Okay, this type of gap will give you a gap filling. So if the market will again come back to fill the gap, okay, so that is the time when you can enter in the trade, and that trade will work flawlessly for you, efficiently for you, right? Now the second thing is that if my market is opening, okay, but it is not opening above the high or below the low point of the previous day, but still there is a gap up. Okay, so that is a common gap in the market, and the market usually comes back to fill that gap. Okay, but you don't have to wait like the market will retrace back from that common gap. That is not usually true. Okay, so you can just ignore the common gaps. They occurs very frequently in the market. Okay, and they will not give you any efficient trade. Right, so these are the three types of gap that we have discussed. Okay, so for sure we will see some examples of them as well. Okay, now talking about the third gap or fourth gap, you can say. Okay, talking about the fourth gap, that is your, you can say, the breakaway. Okay, so the fourth one is the breakaway gap. Okay, what is a breakaway gap? For example, your market was in a range, you can say was moving in a range from a very long time. So you can suppose this is your resistance and this is your support, right? So your market was moving in a range, and then on the very next day the market started here, okay, and it broke your range here. Okay, so this was your resistance. My market actually did not break the resistance, but it opened above my resistance, right? So that is the condition that is known as the breakaway gap. Okay, that is a breakaway gap. Now whenever there is a breakaway gap, so usually what will happen, if my market is opening above this resistance, okay, without breaking it, okay, so what it will do, it will again come back to this resistance, okay, and it will be acting as a support, and then it will again go back from here. So you have to wait for the market to retest at this resistance, and then it will go in the upward direction, right? Similarly, if this was the support and my market was facing rejection from this support, okay, multiple times, and now there is a candle that actually opened here, okay, breaking away from the support, right? So it will again retest itself to the support, and then you have to take the entry when the market will retest, and then it will give you a good movement in the downward direction, right? So this is a strategy that will help you out whenever there is a breakaway gap. I hope the concept is clear. That was our fourth type of gap, right? Let's go on another type. Now that is the fifth type of gap, and the fifth type of gap is your, you can say that is a continuous gap. Okay, that is a continuous gap. Now what is a continuous gap? Okay, now when we are talking about continuous gap, so you can take the example of intraday candles, right? For example, if I'm talking about 15-minute candle, so this was my first candle, then after that this was my second candle. Okay, now I saw then there was a very next candle which opened something like this. Okay, so you can see it was an intraday market because I'm analyzing the 15-minute candles here. Okay, 15-minute candles here, you can see the closing was here. Okay, the closing of this candle was here, the closing of this second candle was here, but when the next candle opened here, okay, so it actually opened here, right? So you can see there was a gap up, okay, in a running market, so that is known as your continuous gap up. And whenever there will be a continuous gap up, it means there is a shift of interest. Okay, so if my market was moving in the downward direction, and then you can see, for example, this candle closed at 400, okay, and the very next candle it started at 430 in the continuous market, you can say. Just a second. In a continuous market, so in a continuous market, okay, so what you will analyze now, from 400 to 430 there was a jump in a running market, okay, when I was trading in intraday. So that will mean there is a shift of interest, and now the market will go in the upward direction, okay, and vice versa as well. Vice versa, it means if my market was going in the upward direction, okay, in the upward direction, and then there was a red candle which gave me a gap down in a running market, so that will be indicating the shift of interest. So now the market will go in the downward direction, so you have to trade bearish. Okay, so that was our fifth kind of gap, right? So I hope it is also clear. Let's go on to another one. Okay, then moving ahead, then we have the sixth kind of, that is our exhaustion gap. Okay, that is our exhaustion gap, right? Now for the exhaustion gap, let's suppose there was a very good movement in the market, okay, previously, and you can see it was something like this. So your market moved upward, okay, your market moved upward, and it made a resistance at this point of time, okay, and from there your market went downward. Okay, now again the market is moving in the upward direction somehow like this, right? So this is a very good resistance, you can see, because the market was facing rejection previously from here, right? Again, I am expecting the market can move up, but actually what happened, there was a gap up opening and the market jumped here. Okay, there was a gap up opening first time, second time, third time, and the market actually jumped here, right? Now what will happen in the exhaustion gap? In exhaustion gap, you will always analyze the market will be giving you a gap up opening to reach the resistance, right? But all of the buyers will be exhausted there, right? So that is the meaning of the exhaustion gap. So all of the buyers will be exhausted there, okay? So you can see all of the momentum has already been used, okay? And whenever there will be this kind of candle, so you will analyze there will be a very huge volume, okay? Huge volume as well. Okay, so you can see there were very good candles here, okay, green candles giving me a gap up openings to reach the resistance with a very good volume. So you can see all of the momentum of the buyers has been used. Now they are exhausted, okay, and from there will be a downward shift in the market, okay. So that was your exhaustion gap when the buyers use all of their momentum, okay. Similarly, you will notice in the downward direction as well. So for suppose your market went in the downward direction and now it is creating a very good support here, okay. Then it went into the upward direction and from there were some candles somehow like this. Then the very next day the candle started here, okay. So there was a gap down, okay. After that there was also a candle something like this, okay, and with a very good volume. You can say this is a volume bar. So there was very good volume at this candle, right? Now you can see the sellers has used all of their momentum to take the market to this support, but now they will not be able to break it, and from there your market will again reverse back, right? So this is what you call the exhaustion gap, when all of the momentum has been used to reach the resistance, to reach the support, and now the market will not break it, but actually it will reverse back from there, right? So that is your exhaustion gap, okay. Always keep it in mind, you have to analyze volume also whenever you are using the exhaustion gap there, right? Now let's go to another kind of gap, and that is your island gap, okay. So we are going on the seventh type of gap, and the seventh type of gap will be your island gap, you can say, or you can say reversal as well, right? Many times what happens, for example, your market was moving here in a sideways range, and there on the very next day you saw there was a gap down opening, okay. So there was a gap down opening and now your market was moving here, right? Then on the very third day, so this was our first day, this was our second day, and on the third day you again notice there was a gap up opening, okay, and again your market is moving here, right? So you can see this was my first day when the market was moving here. On the second day it gave me a gap down market, it moved here in a range, and then on the third day it again gave me a gap up, okay. So my market was moving here. You can see this was the market that was excluded, okay. So this is a island, and whenever this type of gap will be there in the market, so it will denote as the reversal. So what it is suggesting, your market came here, it made an island, and then again it will go in the opposite direction or in the upward direction. So whenever there will be an island gap, it will suggest you a reversal in the market, right? So I hope the concept is clear, all of the gaps are clear. If you are still confused, you can just rewind the video, you can again saw all of them, and let's see if you are getting any examples with these type of gaps, okay, in the application. So for that I will be opening Concept application here, and let's directly go on the charts trade in order. And let's take Bank Nifty, because we usually see good gaps in Bank Nifty. So first of all, before Bank Nifty, I'll just take the example of Infi here, okay. So I'll take the example of Infi here, and Infi, I am analyzing Infi in 15 minutes. Let's analyze it in 15 minutes, okay. Now in Infi, you can see in Infi you can see there is a very good example here of the last kind of gap that we have talked about. You can see the market went upwards, okay, the market went upwards. Let me select the marker from here as well, okay. So okay, perfect, right. So you can see the market went in the upward direction, okay, your market closed here, then there was a gap up opening. You can see there was a gap up opening, okay. So this was our first day, then this was our second day, my market traded here, okay. On the very third day it gave me a gap down opening, and this was my day third, okay, and then the market started trading downward. So this is what this is. So this is a island, you can see it is excluded from the mainstream, right? So the market will change its direction in the negative direction from here, right? So this is how you have to analyze the island market, okay, island gap, you can say, right? Let's see if you are getting any other kind of gaps here, okay. So let's analyze them as well. So let me find some example, okay. You can see my market, this was my market, okay, and then I can see there was a gap up opening, right? In this gap up opening, you can see the market opened up, right? But it has not opened above the high of my previous day. So that is my common gap, that is not my gap up, okay. What I will analyze as a gap up, so I will also show you example of that as well, okay. So let me see if I'm getting any example here, right? So let's see, this was the market of 12th. Okay, so you can see this was the market of 12th. So my market started here on this candle, right? It traded here, and then on the very next day there was a gap down opening. Now you can see this gap down opening is below the low of the previous day. So that is my actual gap down, and whenever there will be actual gap down, you have to mark that gap. Okay, you have to mark that gap. So if this was, let me zoom the chart a little bit. Okay, I hope it is clear now. Right, perfect. Okay, now this is my perfect gap down, right? It is not a common gap, but it is a perfect gap down. Whenever there will be a perfect gap down, I will just mark this zone. So this is my zone. Okay, that was a gap down, and I will just extend it further, right? Now, whenever my market again reach, whenever my market will again reach at that level, so you can see my market again reached at that level. So it moved there to fill the gap, right? And we always use the gap filling whenever there is a proper gap up and proper gap down. So this was the proper gap down. My market went there for the gap filling, and then it went downward. So that is how you will use the gap filling strategy with the help of a proper gap up and gap down. Whenever there will be a common gap, okay, so you will not use the gap filling. Okay, so I hope the concept is clear. Now I have shown you so many gap strategies, okay, how various type of gaps. You can analyze those gaps by your own, okay? Just use your charts, do your analysis, okay, and let me know in the comments if you are having any kinds of problems, okay, or doubts, okay? So अगर आपको वीडियो पसंद आया, if you got to know something good today, you can just like it, make sure to share it with your friends as well, and अगर आप चैनल पे नए हो, सब्सक्राइब करके जाना. Thank you so much guys, this is your trainer Ankit Singh Rawat. Have a good day.